This discussion is about futures strategies, using futures to manage equity risk. When we talk about risk, one way to measure risk is through standard deviation, say of a single stock or of a portfolio. But usually, when we talk about portfolios, the way we measure risk is through something called beta. And the beta of a stock or of a portfolio involves looking at what goes on with a broader market index. Let's call that, say, the S&P 500. The S&P 500 is often used as a market index because it's the 500 largest firms, public firms in the United States. And if this blue line is the S&P 500, then a beta, let's say of a portfolio, denoted here in yellow, a beta measures how closely that portfolio tracks on a day-to-day basis movements in the S&P 500. If a stock has a high beta, then every time the S&P 500 is up, this stock is going to be up by more than that. And any time that the S&P 500 is down, this stock is going to be down by more than that. So this is what happens with a stock that has a really high beta. And for such stocks, we say that they are more risky because they're more risky than that of the broader equity market. Now, normally, when you have a risky security like that, something with lots of volatility, something with lots of standard deviation, one thing that you can do to get rid of that volatility, or at least reduce it, is to diversify, to add other investments besides just that stock into an investment basket. Because if one stock goes up, maybe one other stock that's in this basket goes down, and so the net effect is that your portfolio of these two securities is somewhere in between. And that's the idea of diversification. If you start to combine a whole bunch of securities, each of them individually quite risky, the net portfolio effect of investing in all of these securities is something like this. Diversification washes out a lot of this individual risk and results in a portfolio that has lower overall volatility. But the reason why we look at beta as a measure of risk and not standard deviation is that even if I pursue this strategy of adding more securities into this portfolio, more and more and more and more and more and more, there comes a point where adding additional securities into this portfolio doesn't really do much to reduce that portfolio level volatility. There's a diminishing return to diversification, and there's still going to be some residual volatility that's left over. The S&P, for example, is a basket of 500 securities, the largest 500 firms in the US, and that's a pretty diversifying number. That's 500 of these individual red lines. And yet the S&P 500 is actually, if you look at it on a day-to-day basis, quite volatile. Diversification gets rid of volatility, but it doesn't get rid of all the volatility. And the market volatility, the volatility that's left even after diversification, that's called market risk. And what we're really looking at when we look at beta is the sensitivity of any particular portfolio or stock to this market volatility, the sensitivity to market risk. This is why portfolio managers look at beta so much, It's because that's the type of risk that cannot be diversified away. And so when it comes to using futures contracts to manage equity risk, beta is going to play an important role in that. In particular, a portfolio manager will use equity futures to effectively adjust a portfolio's beta up and down to kind of get that equity portfolio to a desired level of risk. So let's take a look at what that would entail. And the first thing that we need to do is to identify a futures contract that will help us do this, as well as the beta of the futures contract. So let's say we were managing a large cap portfolio. So we had a bunch of stocks in this portfolio. They were all very large publicly traded companies. A good futures contract, an equity futures contract that would track that would probably be a futures contract on the S&P 500. The beta of this futures contract is the vast majority of the time going to be the same as the beta of the underlying. So in this case, the underlying is the S&P 500 index. And if you recall, we often look at the S&P 500 index as a proxy for the overall equity market. So the S&P 500, the underlying here itself, actually has a beta of 1. We're always measuring stocks in proportion to how much this S&P 500 is moving, because we're using the S&P 500 as a market index. And so it's sort of like the S&P 500 is the baseline, and that's why it's 1. If this yellow line, the portfolio, has a beta of 1.5, it means it's moving 50% more than the underlying S&P 500. So the S&P 500 has a beta of 1, and that's why the beta of the futures contract on the S&P 500 is also 1. We need to know this as part of figuring out how many futures that we need to trade if we want to adjust our portfolio so that it has a beta of some particular target amount. We'll call that target beta B sub T. That's the beta that we want our portfolio to eventually be at, and we'll use futures contracts to do that. So we know what the beta of the futures contract is. It's the beta of the underlying, and we can get that from many different financial data providers. And we know what the futures notional amount is for whatever futures contract we're trading. If you recall, that's also sometimes called the multiplier. And we'll just need to figure out how many futures contracts we need to buy or sell to adjust our portfolio beta, with the end result being that we're trying to get our portfolio, call that S here, to have a particular desired target beta. And remember, the reason that we're doing this is that we're trying to adjust our equity portfolio so that it's got a certain level of risk, a level of risk that we're more comfortable with. So we've found out the beta of our futures, and we're thinking about how many futures we need to buy or sell to get us to some level of target beta for our equity portfolio. And so the last thing that we need to consider is the beta, the current beta of the portfolio itself. So if S is the value of our portfolio right now, say we manage $100 million, this is our equity investment, that's the value for S. And then beta sub S is the current beta of our portfolio. And maybe it's too high, maybe we need to decrease the beta, we need to decrease the level of market risk involved to get to something where the beta is lower. Maybe that's the point of what we're doing here, trading the futures contracts. But these three components together are what we need to consider in order to do that. And each of these is known. The beta of the portfolio is known. The dollar value of the portfolio is known. It's the however dollars we have invested. We know what level of risk we want to get to. And we know the beta of the futures contract, and we know the notional, like how much dollar exposure one futures contract buys us. That's F here. And so the one unknown is how many futures contracts to buy or sell such that this all gets us to our desired target beta. And the point is that if beta here is high, then we need to reduce it by selling futures contracts such that the net result is a lower beta. And vice versa, if beta is too low and we actually want to increase market exposure, then we need to increase the target beta by buying futures contracts on the underlying index. But either way, we need to figure out how many futures contracts to buy or sell. So let's take a look at that next. It turns out that if this is what you want to solve for, you can rearrange this formula above to do just that. And if you do, this is the resulting formula that you get. And so to play around with this a little bit, notice that if I wanted to reduce my beta of this portfolio, if I wanted to eliminate all of the market exposure, if I wanted to eliminate any risk of this portfolio, I wanted to make it not move at all, regardless of whether the broader equity market went up or down, then the target beta would be zero, a zero beta portfolio, no exposure at all to the equity market. And if that's the case, then this formula simplifies down to this, which means that I'm really taking the ratio needed to have my futures contracts be the same size as my portfolio. And then I'm just kind of doing this scaling thing because the beta of my portfolio may not be the same as the beta on the underlying futures contract. So to put some numbers to this, the number of futures that I need to sell here, because it's a negative number, so the number of futures that I need to sell would be depending on the size of my portfolio. Let's say I have $1 million invested in the equity market. It's a portfolio of $1 million. And the futures size, one futures contract, is worth $275,000 of market exposure. $275,000. This is for the S&P 500. So I'm buying a futures contract on the S&P 500. So to really equate these, it looks like I'd need to buy about a little under 4 futures contracts to sort of have the movements in the futures offset the movements in the overall portfolio here. But that's not quite true, because I also have to consider that the beta of my portfolio may be different than the beta of this futures contract on the S&P 500. And that means that I need to know the beta of my portfolio. For the moment, let's take that as given and say it's 1.2. And then I also need to know the beta of the futures contract. And since this is a futures contract on the S&P 500, we know that that's 1. And so this is the other component needed to this equation, the ratio of the two betas. And that's what I need to know in order to completely eliminate the risk of this portfolio, the equity risk. This number on the right reduces to 3.63. Let's just round that up to 4 futures contracts here, or a ratio of 4. And this on the left-hand side here reduces, well, it's divided by 1, so it's just 1.2. And what's going on is that this is saying that I need to sell more than 4 futures contracts in order to eliminate the equity risk of this portfolio. In fact, it's 4.8. If we round it up, it's 5 futures contracts. And the reason why it's more than this alone is that the beta of my portfolio is higher than that of the futures contract itself. So if I want to adequately counteract movements in my portfolio with futures contracts, offsetting futures contracts, I have to use more futures contracts than I might otherwise think, because it just takes more of those futures contracts to kind of match this outsized beta of the equity portfolio. But what will happen, the net result of this, is if I've got this relationship where I want the target beta of this portfolio to be 0, I don't want it to move at all with respect to the equity market, then my portfolio beta is 1.2, and this is $1 million. This is like your equity investment component. This is what's going on with your equity. And then on the other side here, you've got actually, it's a plus here, but you're shorting minus 4 futures contracts, 5 futures contracts. Times the beta of the futures times the value of each futures contract, the notional value. So if we get this total here, or at least get rid of the 1 and simplify it. Actually, let's simplify here this part, the minus 5 and the 275. Then we're starting to get the relationship that we want. This part is our portfolio it's measuring how our portfolio is going to move with respect to the market. It's going to move this $1 million is going to move up. If, say, the market moves up by 10%, then this $1 million is going to move up by that times 1.20, the beta. It'll move up by 12%, 20% more risky than the market, or 20% more responsive than the market as a whole. But on the futures side, because we wanted to eliminate any sensitivity of this portfolio to the market, there's this offsetting action that's occurring. If the market goes up by 10%, then 10% times this 1 here, because we've got a beta of 1, means this 1.35 million is going to fall in value by 10%. So the sizing isn't exactly correct because we have 5 futures contracts. We had some rounding that we had to do just because of the standardization of the futures contracts. But we've more or less resulted in a portfolio that has no exposure to the market. If this value goes up, this value goes down by just about the same amount. And then likewise, if this value goes down, if the value of the portfolio falls because the equity market is falling, then this, because of its negative number, is actually rising. And so the two are offsetting each other in a way that the net effect of this is that this portfolio has zero exposure to the equity market. And ultimately, that's what we're trying to do with these futures contracts. We're managing equity risk. In this case, we're actually trying to create a zero beta portfolio, a portfolio with no equity exposure. But that's not always what we want to do. That's just a specific example of what we can do with futures contracts. So let's take a more realistic example, a final example of maybe reducing our portfolio not to a zero beta, a target beta of 0, but to something less risky than the market overall. A beta, say, of 0.8. We can still keep the rest as is, a portfolio of $1 million with the portfolio beta of 1.2, and with us still using the S&P 500 futures contracts to adjust this equity risk of the portfolio. But if we want to bring our portfolio risk from 1.2 to 0.8, reduce the sensitivity of our portfolio to the movement in equity markets, then with these numbers we can solve for the number of futures contracts. Because we want to reduce the risk of this portfolio and not increase it, it is possible to actually increase the risk of your portfolio. Maybe if you thought that the equity market was going to rise in the near future, but because we're reducing the risk of our portfolio, we know ahead of time that we're going to sell futures contracts. We're going to position ourselves with these futures contracts to make money when the S&P 500 falls. Because by selling futures contracts, we are short the underlying, meaning that we profit when that underlying falls in price. And by having it fall in price, we make a profit, and that profit offsets the losses that we have in this long portfolio that we've got, S. So that's exactly what we're trying to achieve. We're trying to offset some of our potential risk, some of our losses, when the market goes down, and therefore our portfolio goes down as well. So plugging these numbers in, a target beta of 0.8, which is less than what the current portfolio beta is, and with a futures beta of 1, we need to kind of scale that position. The futures beta of 1 is there because we've got a futures contract on the S&P 500. If we were going to use a different futures contract not on the S&P 500, that number may not be 1. It may be a different beta depending on what the underlying is. But then also, to fill out this formula, we need the total value of our equity portfolio, here $1 million, divided by the value of a single futures contract. And that will vary depending on what futures contract we buy, what the underlying is. In this case, in this example, one futures contract on the S&P 500 is worth $275,000. And that's it to figure out the number of futures that we need to buy. And so if we simplify this, the top here goes to minus 0.4, and that minus number is there, meaning that's just kind of verifying that we're selling the futures contracts in order to get a reduced beta. And then on this term here, this simplifies to, as before, we had 3.63, which we rounded to 4. Let's this time round all the way at the very end. And we get 1.45 futures negative. And let's just call that 2. So the number of futures contracts on the S&P 500 that we need to short in order to get our overall beta of this portfolio down to 0.8 is somewhere between 1.5 and 2. Now, if we go closer to 2 instead of 1, that just means we're going to get a beta probably below 0.8. If we shorted just one futures contract, it would be above 0.8, somewhere between 0.8 and 1.2. It's probably a beta of 1. So that's kind of like a fine art, I guess you could say, to figuring out your exact size of how many futures to short. There's just that rounding issue that you've just got to deal with because of the standardization of the contracts. But that's it. And the only thing that I would mention in addition is that if you wanted to increase your risk, because maybe you thought that the market was going to increase, and by having a higher beta in that type of environment, you will have a higher return. Your portfolio will increase even more than that market increase. And you can use the exact same formula to figure out how many futures contracts you need to, in this case, buy in order to increase your market risk. And you could just buy more stocks. Certainly that's the case. But maybe you thought that this was just a temporary increase in the markets that you thought was going to happen. And buying one futures contract instead of buying $100,000 worth of additional stocks or whatever the amount is that you think you should buy, this can actually be a cheaper way to get equity market exposure than buying a bunch of individual stocks outright. Buying one futures contract's super cheap. It's like $2. Whereas if you bought $100,000 worth of individual equity securities, that could be more costly. But note the absence here of a negative number. And that's because we are net purchasing a equity futures contract. It's not a reduction of risk, it's actually an increase of risk. But you can use this same formula to manage that exposure.